Hi, my name is Kim Watson. In this video I'm going to cover the subject of correct position sizing. Now a quick important note first. Understanding risk is absolutely essential to become a consistent, successful trader. If you don't understand what risk you're taking and the risks in the market, you will always, in the longer term, fail. Unfortunately, you may have some lucky moments, but in the longer term you'll fail. You must understand risk. That is what divides successful professional traders to unsuccessful retail traders. So that's the difference between the two of them. There's no reason why you can't be a successful retail trader if you follow the rules and understand risk in the same way as a professional trader. And here we go. Let's get to understand it. Now there's a number, when I mention risk, there's a whole raft that I could list out in terms of different factors on risk and understanding the different elements, if you like, but I'm not going to do that because I'll only bring in other factors and we start debating and going down the whole road. I'm just going to cover one aspect of it, as I said, and that's position sizing. Now I've noticed that there's sort of two main points where traders go wrong on, so I'm going to cover those 2 points. Firstly, it's getting hung up on the amount of often points, and they term everything in points or pips, that the risk is going to be. So for example, if I said to you you're going to risk 25 points on this one, how do you feel? Comfortable? It feels like a nice number. If I was to say you're going to risk 75, do you feel the same sort of level of comfort? And if it's 100, there's a lot of people then that say, no, that's too big, I don't want to be. So they're deciding whether they're going to take a trade firstly based on what feels comfortable in terms of a number of points. But the number of points, if you're calculating your risk out properly, is pretty much irrelevant. It's important, but the number, there's a one factor that is a constant, and that's the amount of money you're going to risk. The size of the trade in terms of position size in terms of points is not a consistent measure, and it's just a variable, but you're always going to be risking a set percentage of your account. Doing it that way around, then you've not got the tail wagging the dog effectively. Then the other factor of this is the other part that they go wrong is they're taking trades based on the minimum position size offered to them by their broker. So their broker is determining how effectively what trades they will take and what they won't take because of the sizing of the minimum trade position, trade sizes. So again, you've got the tail wagging the dog. Now it's so important to use a stop that fits the trade rather than the stop that fits the trader's funds, in a sense, or the brokerage that you're using. So let's just go through some examples, and maybe it'll make things clearer to you. Now let's just say you've got a setup here and you're going to put a stop at the top there. You're waiting for a break here and you've got a target down here. It doesn't really matter, but for a moment let's just say that the risk is 100 pips. Now where a lot of people go wrong is they get, as I said, hung up on the fact that it's at 100 pips. It doesn't matter. What's matter is looking at your account. Now a lot of traders, to be fair, are trading somewhere with £1,000 or £2,000, somewhere in that region. Why do I know this? Because brokers tell me the average size of their accounts are often 1,000 or less of a lot of accounts. People dip their, and there's nothing wrong with this, they're just dipping their toe in the water just to see, well, if I can make some money on 1,000, I can put 10 in, or 20, or 50, 100. I feel much more comfortable, but I'm only going to risk a smaller amount in the first place. But if you're risking a smaller amount, you're going to make a smaller amount to be fair as well. but in percentage terms you won't be making any smaller amount if you're sizing your positions correctly. So on £1,000 account, how much do we want to risk? Do we want to risk 100 quid? Hopefully you just said no, because that would be 10% of the account. Get 4 of those go wrong and you're down to 600 quid. So the risk position sizing should be done on the R factor, the risk, and I would recommend 1%. Now some people will say, well, you go up to 2%. Yeah, you can go up to 2% if you want, 1.5%, 2%, somewhere in that region. Start putting much more than that and your account loses quite quickly and can be quite affected. As soon as your account runs from sort of the break-even area down a little bit, you've got to then make a lot more money to get up to where you want to be. So the key thing here is risk should be a constant, and it should be a constant against most trades. Now there may be some strategies you're testing out. You might want to go with 1/4 or 0.5% on those strategies if you can. If they're on that basis, you've done all your back tests and you're running live. Most trades, if you've already done your analysis and you know where the probability is, you'll be running at a consistent. If you start messing up the consistency here, so position sizing, messing around with the I'll go 0.5% this one, 1% the next one, soon becomes the potential for loss. So taking this example, 1% of 1,000 is you can risk, we'll call it 10 quid or $10, whatever you're trading in currency wise, 10 euros, doesn't matter. So it's 10. Your risk is 10. So risk is 10. So effectively, depending on the type of account you got, then that's when you look at your risk. Now I said a lot of people get hung up by this number here. Well, it shouldn't make any difference what this number is, within reason, but the brokers will then give you a minimum size, and that does make a difference. A lot of traders will aim and they'll say, well, I only want a spread bet account because I don't want to be paying tax on my profits. I always smile a little bit because there's not too many traders making money, retail traders making money, unfortunately. At least 80% lose money. So does it really matter if you're using a spread bet account or a CFD stroke Forex account? At the end of the day, paying a bit of tax is the last of your worries. Making money is the first and the key point of what we want to achieve. So we don't want to be sitting there in that 80% group. So forget about that. Get the right size, right type of account that fits with what you're trading and what you're trying to achieve. Now I'm using this very much focused on currencies, but the same principles follow through with any other market that you're looking at. The example I will give you here, if your minimum trade, minimum size position that I can take on this account, and then I can understand you're going to be risking 50 quid on this trade as opposed to 10 quid. So that will put you off. But if you don't trade it, then your probability of your strategy is messed up, and that in itself is a risk. So if everyone that you come along, you should trade. So you need, as I said, go back to it again, you need an account where the minimum risk isn't going to be getting in the way of your funds. Now if you've got 100 grand in you're not going to run across a problem here. But when you've got smaller accounts, then you are. So the other thing then is if you're risking 50 instead of the 10, 4 trades go wrong, all of a sudden you're minus 200 as opposed to minus 40. And you can see what the trader that's going to make the money or stand better chance. I'll talk about this dip here. You've fallen off the cliff edge with your minus 200, whereas these guys are just down here somewhere. Barely any, not a problem too much at all, or not a problem at all. We're going to have losses, and that's just part of the way we trade and how we trade. Is we're going to have losses. It's not as a game where you're going to have 100% probability of doing something. So this doesn't work on this size account effectively. Is a big no-no. It's not going to work. It's not going to give you the right sort of trades. So if that is your account, you can either ask and see if they have an MT4 type on their spread bet, and some do. And if they got a MT4 type, then the positions worked out slightly different. If we were looking at it purely in spread bet terms, we would ideally still be risking £10, and at 100 pip stop, that would be 10 pence, wouldn't it? 10 pence per point effectively at risk, as opposed to the 50p minimum. So if that, sorry, it's very scruffy here, but I think you can get the point, get the gist of this. Is 50p is what they're suggesting is the minimum bet on this, as opposed to what you should be betting is 10p. So that extra 40p is costing you big time when it goes wrong. Okay, now there will be the argument for yeah, but hang on a minute, I'm on 50p. When it goes right, I'm going to be making 4 or 5 times the amount. Okay, maybe it's not the way to be looking at it. We're talking about managing risk. We can't measure or manage the outcome of our trade. We can only manage what we can manage. So if you're managing the risk, that's where the focus should be on, not the outcome. The outcome is just lucky. In a sense, it's just whatever happens in the great scheme of probability. Okay, we got to that far. Then finally, I'm just going to bring up on here a risk calculator. Then here's one I already put some numbers in, but I'll run it through with you. This is myfxbook.com, and it's their forex calculator. It's as good a tool as any. There's others out there, just forex calculator position, and this is for forex. Obviously, trading with other things such as indices and things like this, you need to calculate thoroughly what your risk is and your position size. This is a great tool because with currencies it gets a little bit messy at times, because different currency pairs that you're trading will have different values. So on this, you can decide on what currency pair you're trading, pop that in at the top there. Your account currency, let's say it's in pounds, pop that in there. Account size, let's say you've got £1,000, so pop that in there. And this is going to vary as well. So of course, as it gets more, gradually your position size will be gradually getting more, and vice versa. It may be less when your money's going down. So it keeps you in the game a lot longer. Then your position size. I've put a 1%, as I've said before. You shouldn't be varied too frequently. It may be varied with different strategies, but that's got to be a consistent across that strategy then. So 1% risk. And then your stop. Let's just say I've got the 100 pip stop needed for the trade. Trade size lots, you just leave that as 1 and press the calculation button, and there we go. The money at risk, so your results at the bottom here, you're going to be risking £10 on that account, and the sizing for that account is a minimum size. Actually it's just over the minimum size that you could trade anyway. So it's actually, you're only going to be trading 0.01 lots. So it's the smallest position that you can take, but that's what you have to take. Now there will be a time that if you was to put in a 200 pip stop that you might not be able to, it might just throw you out. Let's have a look and see what it does on this actually, but it would be, then you're starting to risk more, and it's still sticking with the same amount, but you shouldn't that's when having too smaller an account size, particularly when you're trying to swing trade or even day trade in the higher volatility markets, you need to have the correct positions. If the tail's wagging the dog and you're constrained by position sizes or the correct R level, relatively, you're on the back foot already. So hopefully that all makes sense. So in summary then, in terms of correct position sizing, control what you can control, and you can control the amount that you're putting at risk. Ignore how many points it is or pips it is. Don't worry about that. That's just what the stop is. So that the stop is the stop is the stop. Trying to reduce it because you can only afford to lose X amount, you're more likely to get stopped out. So that's not going to gain you anything. So what you can do if you is change brokers or change the platform you're using with a broker. There's plenty of brokers out there that will allow you to use MT4. Then most of them offer MT4, and if they don't use MT4, maybe they've still got you've got the opportunity to trade with a smaller size anyway, if necessary. And as I said, that is pretty much it. Right, get rid of the hang up. Get the right broker and do the right calculations, and if you're managing the risk factor, the rest looks after itself. Okay, any questions, pop them on the bottom here. Take care and manage your risk.